בשמיים. אנחנו מאמינים ומאמינים, ואין לנו על מי להישען, אלא על אבינו, אבינו שבשמיים. אל תירא ישראל, אל תירא, כי גור אריה לא אתה, ואריה ישק, מי לא יירא, מי לא יירא. אל תירא ישראל, אל תירא, כי גור אריה לא אתה, ואריה ישק, מי לא יירא, מי לא יירא. אין חייל שמפחד את האמונה לאבד, כי לנו יש את מלך העולם, והוא שומר אותנו מכולם.
What happened there, guys?
אין יהודי שמפחד
Hold on, it's not yet 8.
את האמונה לאבד,
Aaron, what happened there?
לפחד, כי לנו יש את מלך העולם, והוא שומר אותנו מכולם. עם הנצח לא מפחד, לא מפחד מדרך ארוכה. עם הנצח לא מפחד, לא מפחד מדרך ארוכה. יא לה 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 לה, יא לה 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 לה, יא לה 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 לה, יא יא יא, יא לה 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 לה, יא לה 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 לה, יא יא לה 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 לה, יא לה 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 לה, יא לה 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 I'm not afraid, I'll never afraid כי יהודי לא מפחד I believe in Hashem, I trust in Hashem There never is a moment when I'm all alone and I'm on my own I believe and I trust in Hashem אני מאמין בהשם, מאמין בהשם לא תוכלו לשבור את אמונתי כי אני יהודי והשם איתי כי אני יהודי אחינו כל בית ישראל אחינו כל בית ישראל הנתונים בצרה ובשביה העומדים בין בים ובין ביבשה אחינו הנתונים בצרה ובשביה אחינו כל בית ישראל עם ישראל לא מפחד השם אלוקינו השם אחד 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 תדע נצח עין עין תדע נצח עין
All right. Good evening, everybody. Welcome to another episode of Responsible Living, presented by Chabad House and Rabbi Masinta. My name is Rael, and tonight I'll be talking to Daryl Myers on all things property in South Africa. As an introduction, Daryl has spent most of his 37-year career holding various roles in the property industry. He started out in construction as a site engineer. He went on to lead various estates to over 1 billion rand in sales. And most notably, he was appointed joint CEO of Investec Property Fund, a real estate investment trust, something we'll discuss a little bit later, that managed an 18 billion rand portfolio with assets exceeding 2 million square meters, with assets both in South Africa and abroad. Currently, Daryl runs his own property consulting company called Sear Property. He consults to Burstone Group, which is formerly the Investec Property Fund, and Fortress Property Group, which are both listed on the JSE. If you've ever eaten at a restaurant or done your shopping at the neighborhood in Linksfield, you have Daryl to thank for that. So Daryl, welcome, and looking forward to the conversation. Let's really just jump straight into it. So really, when most people think about a property investment, two things come to mind. It's your primary residence, somewhere where you live, and a property that you'll own to earn a rental income. What would you say are the key differences between these two types of properties, and can you define both as investments?
Hi, thanks for having me on the show. Look, primary residence it's got a utilitarian value. It's very practical. It can give you a lot of enjoyment in life, and it's not often it's something that gives you a good enough return. I'm sure there's many other asset classes and many other property investments that will give you a better return than your primary residence. But I'm a big fan of owning. I think South Africans have a culture of owning property. Around the world, people are happy to rent and kind of better invest their money. And I think as property cycles become extremely frothy and it's hard to get into the market, people are much more comfortable renting, which that gives an opportunity then for an investor market to play in the primary residential space. So that's where you can buy an apartment or a house and rent it out to people who can really ill afford to buy those properties, and generate a reasonable return. But I think on the whole, let's just say giving investment advice to people, a primary residence is not something we would really classify as a place, as an asset class to invest in to give you an adequate return. I need to caution that in one respect, there's pockets of excellence in residence, in primary residential housing. So, unfortunately, if you're a Johannesburg dweller, you haven't seen much growth over the last kind of 10 years, and I think you're unlikely to see that going forward. But when you look at the kind of double-digit returns that our friends in Cape Town have enjoyed, and again, it's not Cape Town as a whole, but I think particularly that Atlantic Seaboard area where you're getting double-digit returns, effectively your primary residence is doubling every 5 or 6 or 7 years. That gives you some real equity in your back pocket that kind of you potentially never intended to when you invested in your first home. I mean, the big challenge then is to say, well, if I sold it, what would I do? Because I don't think many people in Cape Town are downscaling, so they kind of just enjoy the benefits of owning this ballooning asset, but they never really liquidate it to scale down. The smart money would say, well, sell now and, buy something smaller or buy in Joburg where things are a lot cheaper. But again, it's not an investment. On the investment side, it's exactly that. I think you just mentioned something. It should generate a rental return because they do have there's a cost of owning. It's expensive to own. There's rates, taxes, insurance, things like that. And then, of course, if you've geared it, you need to service the debt. And when it comes to investment properties, that is a road, that's a string a mile long, because it can be anything from kind of apartments, it can be housing, it can go into any of the other sectors, which potentially we'll touch on this evening. But I would say this, that one needs to look at it as a total return and not an income yield, because I was when we had varied estates, it was about 2003 to 2008, very frothy market as well during those times, but the income yield was around 5%. So if you're not getting a total return, which means you're really relying on some capital appreciation along the way, 5% is just not adequate in my book to justify an investment property return in South Africa. So I think if you can generate capital and income of 5%, so let's look for a total return in some kind of double digits, well then, I think you're heading in the right direction. So just caution people that there's a myriad of areas to play in this space. You've got to almost like pick an area where you feel you have you've spotted a gap, or you can just buy into a trend that's kind of rising. And if you've got the money to go and buy an apartment, I always really enjoyed fixing up old apartments. So, if you can pick up something relatively cheap in Cape Town or in pockets of excellence where you see even under, in Johannesburg, if you can find it, you buy cheap, fix up, hold it for a while, find a tenant, and potentially see if there's an uplift over time. It's a very easy market to get in to people because you can gear it quite easily, and about 70-80%, I'd imagine you can.
Yeah, no, you mentioned a lot of good points, and I had some further questions that you've already answered. But I think one of the things as somebody that's potentially looking to enter the property market in Johannesburg, like you mentioned, over the last 10 years, there's been very little capital growth. I know of a few people in my close circle that are struggling to sell their homes, and then looking to enter it. If you do a matchbox calculation, you say, okay, I'm going to take out, an 80% LTV loan, which is, over 20 years at 11-12%. Every 7 years, that doubles the cost of what it actually was to buy the property. And it just doesn't seem like in 20 years' time, the property is going to be worth twice as much as it is today. So, there is this train of thought that, well, if you rent, you're paying off somebody else's bond, but the opportunity cost of taking your savings and putting it into an asset that is just going to cost you money over time, it's a very difficult one. Someone as like a finance person, I find that a difficult thing to do. But again, you have this like emotional, when it comes to your primary residence, you have this emotional connection to it. You want to own it. You want to do things that you want to it. So it becomes quite you got to look at it from both sides. It's a financial decision, of course, and it's an emotional decision as well.
For sure.
But I think, now that we kind of understand the difference between, your primary residence and an investment property, you talk about pockets of excellence. Where do you sort of see that in Johannesburg? Where are people finding ways in which to get yields in excess of 6-7%, after debt service costs and cost of ownership?
So, I think I'll give you a little bit of a track record of what I did some years ago. So when you mentioned the neighborhood, and I hope not all our listeners are eating at the neighborhood because we haven't got a kosher facility there, but at least they can shop there. But let's just talk about the neighborhood. There were two actually amazing developments I did during my time at Investec Property, not in the property fund, but in Investec Property on the development side. There were areas where we found there would be price elasticity. Now, again, not so easy to, it's very intuitive. It's not an exact science, but when we did the neighborhood, we pitched the price of the stands there at the average price of a house in Linksfield, or Senderwood, St. Andrews area. Not the top end, but certainly an entry-level house, I think 3 or 4 million rand you could get at the time. That was the price of our stands. And we just felt that in a secure environment, with limited supply, we thought that would be an absolute winner. And it turned out, I think we launched 185 stands in 2 months. And we achieved those prices. That was the one example. The other one was that we did a development at the Ananda Club, which was about 33 stands. Exactly the same philosophy. That predated Huddle Park, where we actually launched the stands at the same price of houses in Athol. Now, 33 stands. People who invested there have all made money, and I would imagine that if you put your house on the market in any of those two areas, be it Huddle or the neighborhood or Inanda, you're likely to get a fair return. So that's what I've seen. I've always found I had a particular kind of feel or skill set that I could find value in something, and I think that's what you need to, maybe encourage listeners here, is that if you have this skill and you can spot a gap, well, that's a whole lot better than just trying to subscribe to an existing market, which looks kind of a bit miserable and morbid. Here's the thing. We did a development called Copperleaf. I'm not sure if you're a golfer, but it was a estate in complete default with the bank at the time, which was Gardner Ross. We relaunched it as Copperleaf. We sold 550 stands over a period of 7 years, a huge success. So we saw an angle that potentially somebody else hadn't seen. And there's always that kind of play for people who are skilled enough in it. But here's the thing. You've got people that are eking out a reasonable and pretty good return in playing in the kind of, let's call it the lower cost rental model. And now, just be cautious because, again, it requires skill. It requires, I think, actually the amazing thing about this, and maybe that's a positive of this. People who make money in this game often make it when they in markets exactly like we're in now, where people are kind of morbid, interest rates are high, inflation's going up, there's no good news. And so we sit on our hands and we dream about how we're ever going to retire in Israel one day. But the reality is there's probably more opportunities under your nose right now for people who have that kind of entrepreneurial spirit, have that ability to spot gaps, and you're seeing it. I've seen some youngsters coming through the system here doing, converting warehouses into residential apartments, getting 5,000-6,000 rand a month for 18 square meters, but providing an amazing amenity for people who would otherwise be living in a shack in Alexandra. So they've provided an amazing amenity, amazing environment where people feel much safer. Oh, my dog's going to make a noise here. So where people feel safer, their kids are looked after in the day. And that is like somebody spotted a gap there that certainly I didn't see and didn't believe in. And I think that what you have to do is you pick your poison. You say, this is my skill set. This is where I kind of am my happy space. It's weird. Like I used to drive around. I mean, you'll stop me if I'm going on too long, but I used to drive around Joburg in the old days and always look at these apartments on Call It Drive, like Headingley. They're beautiful apartments, and then I saw like all the kind of servants' quarters were on the roof, and I thought, well, isn't that an opportunity to go and buy the rooftops on all those buildings, potentially? Because I'm saying, you're getting yourself like the views, you're getting yourself almost your exclusive use area on the top floor, which are the most neglected parts of the building. They're facing the wrong way. You've got to have these kind of ideas, and then you need kind of obviously somebody to back you, to believe in you. Now, that is often the challenge as starting out. But again, there's a play in residential in Joburg. It's just that I can't really say this is it. I was fortunate enough to have a lot of a big bank behind me when we did Huddle, because it cost hundreds of millions to bring services and things to the area. But it was a huge success. Inanda was exactly the same. For most people listening, I'll be presumptuous and say, okay, how do you play? It's kind of just find a sweet spot that you think you can actually add some value, where you see potentially stuff trading lower than it should, or it just doesn't make sense to you that you can't extract value out of this. I mean, what's the downside? In most cases, there's almost a floor on a downside. The price you pay is kind of your exit. So if you spend a little bit and you're prepared to just sweat it out, I don't think the downside's that high. But there's potentially a new career, in that.
100%. I think what, in the two developments that you did, being the neighborhood and in Inanda, I think where you guys got it right was that you sold a lifestyle. In Joburg, people seek a lifestyle because public services and public spaces are not the best places to hang out. And in both of those developments, you're selling a lifestyle where people can hang out, where there's, it's a safe environment. I've been to that one in Inanda. It's like Fort Knox getting in out of there. But I think that's what, that's what people will be willing to pay a premium for, areas in which they feel safe and in areas where they can live a lifestyle. And I think the point you touched on with regards to the warehouses turning into spaces where people, sort of lower LSM people can live, again, that's selling a lifestyle, and it's attracting a high yield. So I think, what people can take out of this is, if you can see an area where you can sell a lifestyle, it seems like there could be an opportunity where people are willing to pay a premium to be. Personally, I've always liked the idea of like having, short-term rentals, like an Airbnb, in Cape Town. People have seen a lot of success in that. I don't know if you've ever played in that space. But I think, kind of moving on, I think there's often this misperception that if one wants to invest in a property, it has to be a residential property, because it feels like, trying to buy a mall or a warehouse just seems completely out of reach. But I think, there are various investment vehicles out there that allow for people to invest in those types of properties. Can you just tell us a little bit about those, how they work, and how people could potentially, look to invest in them?
So just one step back is that, again, for good operators, people that find opportunities, be it even in like strip malls, let's assume, which might be a fairly large jump up from a residential dwelling, there are often either quite progressive bankers, or there's family money that backs people, That is a huge opportunity for particularly youngsters, if they're out there and they're looking for deals and they think they've got an edge. there's often people that would back them into, and I see a lot of youngsters, you kind of the Tashes and the Nando's brigade that, you see them all the time running around. They're always working on deals, and these guys are active, and they started somewhere. When it comes to bigger stuff, of course, then you've got to kind of look more towards the let the experts manage it for you kind of thing. And that's the real estate investment trusts, the REITs. You're backing expertise, you're backing the diversification of, either they could be generalized REITs, which means you're getting exposure to industrial, office, and retail, but you get specialist REITs. And again, work out what appeals to you and who the players are in that space. But if you just look at the kind of price of those today, and I think they've all been smashed particularly hard in this market. I mean, actually last year, interesting enough, they bumped about 20% up. They outperformed equities, which was quite a surprise, but for whatever reason that is. But these are asset classes that are trading on double-digit yields. And I don't think there's much downside any longer. I think that's been priced in. So, you could be buying some of these assets, some of these units, getting yourself 11, 12% yield, almost guaranteed. You can never say there's guarantees in life, death and taxes, as we know. But the truth is, when these asset classes have been smashed to the point where they're trading at 30, 40% discounts to net asset value, to be getting 11 or 12%, almost guaranteed, and you're going to get a dividend twice a year, so you'll get 6% June and 6% December. It's not something to be ignored for people that want to get in. Hard to gear, but again, if you've got equity in some other form or another, even if it's your house, you could gear. You could gear against it, which means you could get a bit of a additional leverage into those portfolios if you were willing to take on some debt. At these levels, I'd say it's pretty good. I think some of these REITs are trading at the levels of 10 years ago. So, there's probably much more upside than downside right now in the market.
Okay, so when you talk about a REIT, obviously it means real estate investment trust. These are investment vehicles that are listed on the JSE. So if somebody was to want to buy into a real estate investment trust, they would go through a broker.
Correct.
And they would typically want to choose a REIT that focuses on a specific sector. Is that, do they sector specific?
Yeah, so I've got kind of strong views now on where the sweet spots are, and I think where the retail, the REITs that have general REITs where they've got let's call it a significant amount of exposure to offices. Even if those offices have performed well now, I think you're taking on risk that you just can't even manage because of the work from home, e-commerce, and the impact of that kind of return to work, or it's not even work from home anymore, it's like work from anywhere. And I think that's still in a massive state of flux. So if these REITs have a fairly low vacancy, some of them are as high as 35%, I'm not sure it can get any better. And that's going to drag your performance of the sector that you potentially like. So if you're going into a general REIT, unfortunately, you're going to be exposed to sectors that potentially could harm your performance. And I don't even think there's a counter-cyclical benefit any longer of having offices in your portfolio. It's just kind of nobody wants them, and very few people are focusing on them. So as an asset, even within the REIT, there's the expertise of you're trying to manufacture tenants, and they're just not there because there's no, I don't want to be negative, but I'm saying if there's no growth in a country, and you've got all these other issues around work from home, e-commerce, and really big corporates not really making the tough calls of bringing people back. Well, would not be in that sector at all, and just forget about it for now. That said, if you were going to look at an office sector, and I don't want to sound like I'm flip-flopping, but there's pockets of excellence again. What we found historically is that with these big corporate leases that used to be based Sandton, CBD, etc., they've now moved. So people are quite happy to live and work in Bryanston, Fourways, smaller nodes, even Sunninghill. These are neglected nodes, but now they've come back because you can drive to work within 5 minutes, go fetch your kids from school within 5 minutes. So in a multi-tenanted, smaller office park-like environment, if you can get that direct exposure in a market that's been so hard, been so smashed, potentially you've got some upside, provided there's good management on the ground. Now you're going to the sweet spot. Everyone likes industrial at the moment because there's limited stock, no vacancies, rents are fairly low in this country at this rate. You know, and some of it's really under your nose, under your doorstep, and you kind of drive past there every day on the way to the airport, etc. And these are functioning factories and logistics warehouses and storage facilities, and everyone likes that. And there are a number of REITs that focus entirely on that, in that space. And then there's REITs that focus on retail, and I've got really a few favorites in that sector. But you know, I don't give investment advice, but I would say that, you know, just be the portfolios are covered in the, you know, you can go on the online, you can Google these sites, you can check out the malls, you get a good sense of if it's rural, if it's CBD, if it's metropolitan malls. And I think there's a real look, retail's been also, it's been clubbed. I think that there's probably more upside in retail than downside. I was at a talk recently where Investec, one of the guys from Investec Research, I think it was at the SAPO or retail conference, said, like, literally this country at 2% growth, you're going to see these retailers like amplify their earnings at 2% growth, you know. So we're kind of hovering around close to 0 to 1%, and they're eking out a reasonable living, and some of them are doing much better than others. I saw actually Checkers, ShopRite had unbelievable results again today. Some of them are dominating the space, and all you need is a little bit of an uptick, and the whole sector kind of flies, you know, in retail. And so retail subdued, but I would play there for sure, and potentially rural over kind of urban or metropolitan, and then you got to find the REITs that offer you that kind of exposure. Industrials are, you know, it's nodes, and I think it's kind of dry, but you can drink it, as they say. It's dry, but you can drink it. I like industrial is steady Eddie, and you know, there's some funds that have done very well in that space too. And then you've got kind of specialists that have come along the way, like this storage, you know, and I think that's kind of a smart business model. So you buy something in, I'm just giving an example. You could buy, you know, 6-7 years ago in Wynberg, you could buy an asset that was paying you 25 to 28 Rand a square meter at best. The storage guys come, and that's more like we call those operating leases, where you've got an operator who actually amplifies the business. You're not relying on a guy just making widgets and paying you your 25 Rand. Here's a guy who comes in and he says, well, you know, he's going to convert that space into 3 square meter boxes and charge 75 Rand. Straight away, he's got himself a massive uplift on rent. And I think as a landlord, you would have benefited. They're smart enough now to have become the landlords themselves. So they're finding they've extracted the value, and they've vertically integrated their supply chain. Guys like Rail Levitt, you're seeing again, you know, kind of banging out stuff on this inno space, just offering great amenities to a very neglected sector. So, you know, you bring like a hospitality approach to industrial assets where people arrive in the park, it looks lacquer, you've got a coffee shop, potentially a laundromat, potentially other amenities. The park doesn't look like those kind of old, mucky, you know, grotty warehouses where you only ever anticipated getting 30 Rand a square meter, you know. And so that's, again, a bit of like a good operator. He's giving you a lot of amenity with the park, and you're willing to pay for it because it's actually a very cool environment. You know, it's more like an office than it is a warehouse, or it's a hybrid of those two. So you're seeing those kind of players. I'm a big fan of backing good operators in that space.
So I think your final point actually just touched on what I wanted to speak to next, which is, you know, you've touched on retail, you've touched on office space, you've touched on industrial, and I think we can delve a little bit deeper into those. But, you know, trying to give people some practical advice when you're looking for a REIT to invest in. Okay, we've kind of gotten to the point where we understand that having exposure to office space is probably not where you want to be. But what are the other sort of key metrics that you would look at if you got a fact sheet of a REIT that you were now looking to, you know, invest 100,000 Rand in? What are some of the key metrics you would look at to see potential upside?
So, you know, the sectors, you've got to find almost like the stars here, because I want to just be general to say most of the sectors sitting at the same leverage. You know, somewhere between 40 and 45%. So the debt is the same. I look for management teams, and I will look for locations of the assets. And I will tell you this, that if you get the opportunity before you invest to take a drive to something of theirs, you might get a very strong sense of, because here's the thing in the property space, you can't hide. You know, you're not, you know, if you're buying into like whatever, Checkers, you've got to understand their whole supply chain, the bakery, the production line, the branding. There's a lot that goes into it. But you drive past an asset that's managed by a fund manager, you'll get a sense very quickly if this is a team that you could back or not, of how neglected the assets are or not. And that's the real gap in this business. You know, there's some top-down operators. I get that. You know, you've got to have a very kind of a helicopter view on the world of property, but you need to balance it with a bottom-up approach. And if you're not seeing those assets being catered for, that presents you with potentially another opportunity. Well, instead of investing in the fund, why not try and buy the asset? Now, you know, it might be expensive. It could be too big, but I'm saying that's often the play, I think, in, you know, you've got massive, we used to call it the tail of a portfolio. You know, the tail's what drags all your earnings. It's your unlet space. It's your neglected space. It becomes too small for the kind of strategic direction of the fund, and they neglect these assets. And that's where the play comes for smart operators. They see gaps that the fund managers can't see. And then, in fairness, just let me just back this to the funds, is that they spend an inordinate amount of time on admin and time in the office. And the truth is, good property players spend no time in the office and all the times on the assets, speaking to their customers, making sure that the premises are fit for purpose or are way better than the competition in the area. And if you're not getting that, so, you know, you can pick that up very clearly or quickly. So, you know, because everyone's got some exposure to an area where you live, I promise you, and you can get there and look at it very easily. Or next time you're going to Durban or whatever, you can stop over and have a look at some of the malls, whatever it is, you can find it and you'll get a sense of how good these guys are.
That's really interesting. It's a, you know, when you're investing in something that's listed on the JSE, you kind of think of it as a financial instrument, but you make a great point of actually being able to go and experience the mall or the industrial complex that you could be investing in. And you know, that I think when people can touch and feel things and see things, I think that makes it a lot more doable for them. Something I've always kind of pondered and not really fully understood is, and this talks to metrics in property ownership, which is rental escalations. So, you know, you're a guy, you've managed property portfolios, you've had to sell to potential tenants. What is the way in which you go about selling a rental escalation where the asset itself may not have even appreciated, gets older over time, and now you've got to pay more to exist in the same space you had before? And because essentially, you know, rental growth is where the dividends and everything else is going to come from in a REIT. So you talk about a management team. How do they sell this to their tenants?
Okay, so, you know, that is actually a great question. And in some jurisdictions abroad, there's actually no escalation in rents. I think you sign kind of 3 or 4 years and then you revisit it at that time, you know, at that point in time again. But we have significant costs of ownership. Significant costs. And I'll just give you some examples that, you know, insurance post the Durban riots, most property owners are probably paying 35% more insurance today than they were 2.5 years ago. The rates and taxes in this country, it's done on a basis of how much we need in the budget and divide that by the number of property owners. There's no metric to the council's logic. You know, there's no logic. Well, actually, there's a lot of logic. It's quite smart. They just work out how much they need and divide it by who owns the properties. And these things have climbed at 50%. I mean, it's 50% of your op costs are now rates. Then you've got obviously labor to keep the stuff clean, security, etc. So you have a natural escalation in the business. But I will tell you something interesting, because when I started in the business in 1995, we often used to escalate op costs at a different rate to the rental, because most of the op costs, most of the escalation was felt in op costs more so than the rental. So, you know, we push a 5 or 6% escalation in rent and 7 to 8 on op costs now, and that gives you your blend. But you actually do need that, because you have got there's costs of ownership, you know. And then obviously as a private guy, you've got much more flexibility. And if you felt that you wanted to retain tenants by keeping things steady for 5 years, well, by all means, try it. You know, one thing you want to do is you want to be settling your debt. Debt's variable in most cases. So you need to manage that place. But as a REIT, where you've got an investor market that's relying on dividends that are growing, you're hard pressed to kind of keep rentals flat. And again, the accountants, you're an accountant, I think, but you could massage that. You could drip lower rents initially and escalate it yourself so that you can smooth the returns if you wanted to do that. I think people are going to have to box very smart now if they want to kind of attract tenants, certainly to offices. And there's opportunities to start playing in those kind of metrics. I think, if you want to fill your building at all costs, well, why not? You offer 3 years flat. I mean, I wouldn't go 5 years flat, but 2 to 3 years flat potentially could be a good opportunity.
Okay, you sold me well. Well done. Clearly you know what you're doing. So you've spoken about how you kind of like the retail sector, specifically in rural areas. Given the kind of state of the South African consumer, you've got rising unemployment, you've got lower disposable incomes. I think we have the highest, or one of the highest, retail malls per capita in the world. If you're a REIT now, or a developer, are you looking, is there still opportunity out there for additional retail space?
Yeah.
Or have we kind of reached a saturated point?
So there's no doubt we overshopped in terms of malls, but we also have terrible malls. I mean, our best are world class, and then you get very average stock. So I think what you're going to find in this market is the winners win outright, and there's always going to be, then there's casualties, which you actually need, because here's the thing: this wasn't spawned by developers; it was spawned by the retailers themselves. The fact that a retailer can open up, call it Huddle Park, and then explore Dower Glen, and then literally these guys will open every 5 kilometers if they could. And what they're effectively doing is they're locking in their rentals. They're never achieving their turnover rentals, and it's very hard for you to dominate a space as a mall owner. With these, so I mean, here's the thing: they spawn developments. Developers don't spawn developments. They might come up with the idea, but you could say no as a serious anchor. You say no. But I think what you're going to find is that there's going to be real winners and real losers. And if you look in the private space, so the REITs aren't that aggressive right now, or maybe not that optimistic. And I think, in fairness, it's just not their skill set. They're better buyers and landlords than they are developers. But there's some unbelievable development teams out there. I mean, I know three big family players that are rolling out 3 malls each this year. That's 9 malls in rural areas. There's a lot of flux happening in the townships. There's a lot of kind of urbanization and deurbanization. There's people that are living in the homelands relying on those kind of SASSA grants. There's so much. It's a market that you have to understand intimately to be able to extract value or provide value. And you can get it horribly wrong. And I mean, we did too, by the way. I mean, it's like sometimes it looks very sweet, but actually you find that it's not. And it's a market that you have to understand very well. I think as a mall, the challenge for big mall owners is that these small towns eventually atrophy your investments. So if you've got a dominant mall kind of in a second tier town and you're not a developer, that means you have no idea what's going to take place 100 k's from your mall or 30 k's from your mall, east, north, south, east, or west. But a developer mindset is they're going to close the loop in the surrounding towns as well, with the right size. Maybe they'll do a 15 instead of a 25,000 mall, just to kind of make it attractive enough not to eat into the main mall, which is 100 k's away. There's a game plan, and landlords, unfortunately, aren't there yet. So I think, if you're going to be in retail, we used to have a simple philosophy, and I think actually most people do today. You've got to be market dominant, or you have to be very niched. But I've seen both those strategies fail, where you could be market dominant for a while, but if you take your eye off the ball, you'll see developments will be spawned in the outlying areas that service your mall. And if you're niched and you aren't on top of your retail, your malls slide quickly. And I don't want to mention, but there's like malls that are under our noses that I think have been completely neglected over the past kind of 5-6 years, and you can feel it when you go there now. You can just see that they're in such a state of flux that you're actually not even sure what its relevance is any longer. So, winners, losers, and again, it's a specialist skill, Unless, of course, you can buy a ShopRite box with a Pepcore and a cell phone shop if you're lucky enough to find those kind of small little pockets where for 25, 30 years you're going to have a ShopRite, and then you'll always find an Ackermans or a Pep that'll pop along, and then you can, the rats and mice or the hairdresser and the barber or the person selling hair extensions, but it's a skill set.
Yeah. So I think what you're saying is there's an opportunity if you have appetite for, owning them all yourself, but there's a specialized skill set that you need. If
Yeah.
you're an individual investor, you got to look for a management team in a REIT or a fund that really knows what they're doing when it comes to retail malls.
Yeah.
Okay, great. I think so. We've got kind of 5 minutes left here. I'm going to sort of touch on one more point, and then I'll open up to some questions if there are. We've seen, this huge growth in demand for internet-based services. We're using them right now. And if we don't have a data center nearby, the latency or the speed at which we connect to that service will be slow, and we won't enjoy it. So what we've seen is, and I used to work for TechX, we used to do this globally. There's this huge demand for getting data center equipment into all places around the world. I mean, we'll talk about South Africa specifically, but are you seeing opportunities in this space where, people are buying up warehouses and turning them into data center facilities? And it seems like with the growth of, AI looking forward, it seems like this is only going to get, sort of bigger and bigger.
I mean, it's I was looking actually in the American market now. There's two sectors that people are talking about, which is telecoms and data centers. I was trying to work out actually what telecoms is, but my gut feel right now is it's probably a cell phone tower, and the data centers have evolved considerably. 8 years ago, data center was literally like a 1 floor above ground, 4 stories underground, where your staff and your data would be stored if you had drama. If in the event of some catastrophic event, you had an alternative place to work from, which would be safer, or you could run the skeleton, the bones of your business from there. Now, those have become completely redundant. You've now got a 4-story basement, super basement with offices, parking that will never be used, and 1 level. So it's again, data centers have evolved. It's become very specialist. It's unbelievable. I saw numbers the other day of around 300,000 Rand a square meter build cost because of the tech and the stuff that is going into these things. So it's going to be reserved for the big players. I think the opportunity is for big landowners, big industrial landowners will be able to, extract value selling the land to a data center. I don't think you'd want to, would you build it? I think the costs are going to be so through the roof, but potentially if you're getting the return out of it, I've always been a kind of fairly conservative investor or player in that space in a market that I go, if I don't understand an alternative use for the asset potentially, or even if I ask the question, if this tenant didn't exist, what could I do with that space? And if you don't know the answer to that, you've just got to know you better make sure that the business that you're backing is got real depth, because you need it to survive, because you don't want to be struggling. You don't want to be, specialist assets carry a different kind of risk, in my opinion. And sometimes it's best just to extract your value out of the land and move on. If there's a way to play in it, you just got to understand the appropriate risk. It's the same thing like cell phone towers. Theoretically, there's no asset growth. That is just a pure income. It's a tower that's generating you an income in perpetuity, and that can be priced, but it's an income stream. It's occupying 10 square meters or 20 square meters in total, but it'll generate you, as long as there's a need for the signal or distribution of signal, you've got a cash flow, and that can be priced.
Sure. It's an interesting space. I think it's like you say, highly specialized, and it's constantly changing and evolving, and the speed at which it changes and evolves is almost like exponential. I'm going to now look to some questions. The first question we have here is, are you looking to back and fund youngsters in the property space?
No. Unfortunately, I think I spent too many years in corporate and not enough years. So I give good advice, but I don't act on my own advice. I think, but there are players, and they'll know where to find them.
Okay. Good.
You can take that
Um,
offline and guide them.
yeah, maybe people can reach out to you and you can connect
Yeah,
them with the guys
yeah, yeah.
who might be looking to do so. I've got another question here. So it's an anonymous person. They're saying, I want to know what your thoughts are on buying a block of flats within a low income area such as Turfentine, etc. Do a full renovation on each unit and then put in new tenants while having a good managing company to manage the property and then achieve a 20% net ROI. Is this a good investment?
Yeah, look, I think, risk and reward go hand in hand. A 20% ROI sounds very reasonable. My only guidance there is make sure you understand the market that you're dealing in, because buildings get hijacked. There's problems and there's opportunities. And I think that's the thing, is you've got to be able to, you have to know how you're going to mitigate the risk of having tenants in a building. Understand the law in this country. Well, in most countries, it favors the tenants. When people don't pay, you struggle to collect rent and you struggle to move them. If you're not on top of your buildings, then they can potentially get hijacked. If you're providing an amenity where your tenants are happy, and you're treating your tenants like you would want to be treated, or you'd want your parents to be treated if they were living in those same blocks, you've got a very strong kind of business case to kind of move forward, to lock these guys in nicely and to look after them, and they'll look after you. I think that's ultimately if you're doing good, I think you'll get it back. If you're creating if you're looking at purely for income, and at income at all costs, I think you might find yourself taking risks that you never knew existed.
Yeah, no, that makes sense. I think, final question from my side. We've spoken a lot about South Africa here and what the specific risks and opportunities are. Do you have any, I know you don't give investment advice, but do you have a backdrop or something that you can share with the audience around what potential offshore opportunities there are? Or are there some local funds that I know Investec Property Fund had quite a big European exposure? Are there some local funds that people can get some offshore exposure to some of these asset classes that we spoke
So
about?
a lot of the funds do. Vukili's got a great retail portfolio in Spain. Investec Property Fund, which is now Burstone, is still, they've got their Western European logistics portfolio. You've got the NEPI guys. There's a lot of operators that, most of these funds have somewhere between 20 and 50% of their space now, I think, offshore. Everyone's, I always get nervous about this, because if you're relying on the fund manager to make your investment calls here. And I think you're hoping they've done their research or they have in-country expertise. Now, the ones I've mentioned do. So I would just say, do it rather through a fund like that, where they've invested the time, money, and the resource in those areas, as opposed to trying to pick your areas, from here with a fund that potentially is listed exclusively in Poland. Poland's like the new, everyone's talking Poland again. It's amazing. During the Ukraine crisis, people were bailing out of Poland. Now they see the cap rates have softened. Everyone wants to get back in. I'm always cautious of just that kind of wild frenzy into areas, because you are so far from it. You don't even understand that you could be in the wrong node completely. Let the experts manage that for you. But here's the thing: I think most funds today are trying to get investments abroad, but if you look at, people believe, if they think the rand has been hammered too hard, you could end up with a firming rand, or a rand or two, and suddenly your investment there didn't look so sweet. If SA is going through this terrible crisis right now, but there are green shoots potentially, if you get 2 or 3% growth, your retail performance here will shoot through the roof. It should do very well. So you've got to be in this for the long term. The REITs give you a very serious kind of consistent dividend. I would just leave it with these guys.
No, agreed. I think it's a good opportunity to trust local guys who have management teams on the other side. And it just made me think of, when you said you can go and visit the property, when you're doing it and you're buying something overseas, it's a lot harder to go and see what you're buying. So you got to be a little bit more careful when it comes to that.
We had our late chairman at the time, Sam Hackner. He said, when the trouble, when the proverbial hits the fan, he said suddenly the guys don't speak English, and you don't want to be operating in a country where you're struggling to work out, how to correct rent, or who to see, or who to sue.
Yeah, no, that makes sense. Daryl, thank you so much. That was a really interesting chat. I hope that the audience got some valuable information out of it. I certainly did. And thanks everybody for joining, and we'll see you next time. Thanks a lot again, Rolf. Have a good
Cheers.
evening.
Bye.
Cheers.